Welcome back to Auto News Talk. If you've been trying to follow the headlines in the auto industry, you might be feeling a little bit of whiplash.
Whiplash is a polite way to put it. I'd say it's more like total chaos.
Fair enough. But really think about it. For years, we were sold this one single vision of the future, right?
Oh, yeah. Everything electric. Everything sold online. Cars are just iPhones on wheels.
Ow.
That was the hype.
That was the hype cycle, and it was exciting. It drove stock prices. But looking at the reports you've pulled together for our discussion, it feels like the party's over.
The lights have come on, exactly. Yeah. And now the industry has to actually figure out how to pay the bills.
That is the perfect way to frame it. We are moving out of the dreaming phase and into the messy, complicated doing phase.
Very messy.
And what really strikes me is this tension. On one hand, consumers seem genuinely ready to adopt new tech. We're seeing real tipping points.
We are.
But on the other hand, the entire infrastructure is just creaking under the strain.
And not just charging stations, which is what everyone talks about.
No. I mean, dealership service bays, global supply chains, even the investment capital. It's all struggling to find its footing in this new reality.
It's a massive synchronization problem.
Yeah.
You've got what consumers want moving in one direction. You've got government rules shoving the market in another. And then you have the actual businesses, the dealers and manufacturers, stuck right in the middle.
And they're the ones trying to make the math work.
Yeah, and the math is getting very, very hard.
Okay, so before we dive in, help us set the mental map. We've got sources on everything from Canadian trade policy to UK used car data. It feels a bit all over the place.
It seems that way, but there's absolutely a pattern. Think of this as tracing the life of a dollar through the auto industry right now.
Okay, I like that.
We're not just looking at random news stories. We're watching a cycle of correction and adaptation playing out in real time.
So what are the stages of that cycle?
I see three colliding forces. First, there's the demand shift, what people are actually willing to spend their money on versus what manufacturers thought they'd be buying.
Which, spoiler alert, are not the same thing.
Not even close. Second is what I'm calling the supply valve. This is where things go geopolitical. We're seeing governments and markets basically twisting the knob on inventory to force prices down.
Interesting. And the third?
The profit pivot. Simple question. When selling new cars gets really tough and low margin, which it is, how do you keep the lights on?
So we're following the money from the buyer's wallet, through the supply chain chaos, into the service bay, and all the way up to the boardroom.
Exactly. And it all has to start with the customer. If they don't show up to buy, nothing else matters.
Let's start right there then. The consumer. For years, the big excuse was the public just isn't ready for EVs.
We heard it constantly. Range anxiety, price resistance, you name it.
Well, according to this latest polling data from Motors and Kazoo, that excuse is really running on fumes.
It really is. This poll is significant because it suggests we've crossed a major psychological line. The default preference is no longer the internal combustion engine.
That's a huge headline. So if you survey 100 people looking for a car right now, most of them are not starting their search with petrol or diesel.
That's what the data says. 55% of buyers expect their next car to be an alternative fuel vehicle, an AFV. That pushes petrol and diesel down to 45%.
So the technology that powered the world for 100 years is now officially the minority choice.
It's a tipping point. But, and this is a really big but, we have to be so careful with that AFV label.
Right, because the media sees AFV and they just print EVs, and that's not the whole story, is it?
Not at all. And this is the kind of nuance that can bankrupt a car company if they get it wrong. The Motors and Kazoo report breaks down pure electrics. They account for about 24% of that interest.
Still significant, but not the majority.
Right. The dominant force is actually hybrids at 30.5%.
So the bridge technology everyone dismissed is actually the main event.
It is. And it makes perfect sense, you know. Consumers are pragmatic. They want better fuel economy, maybe feel a bit greener, but they aren't ready to go all in on a charging grid they don't fully trust yet. They want that safety net.
Speaking of safety nets, there's another hesitation point in the report I found fascinating. They call it the confidence gap.
This is a huge one, especially for the used market. The report shows that if you're buying a brand new EV, your confidence is sky high, like 80%.
You've got a warranty, sure.
Of course. But if you're looking at a 3-year-old used EV, that's where the anxiety really kicks in.
Because if that battery degrades, it's not the manufacturer's problem anymore. It's my problem. And it's an expensive problem.
Exactly that. Used buyers worry about battery health, obsolescence. It's like buying an old iPhone. You know the new one is better, and you worry the battery won't last.
That risk changes what motivates people, too. I was really surprised by what the report said about government grants and incentives.
You'd think that would be the #1 driver, right? Free money.
But it's not. The source notes that only 35% of buyers said a grant would be the main reason for their decision.
It's much lower than you'd expect. It turns out suitability is the real king. Over half said they'd rather have a car that fits their life perfectly than one that just happens to qualify for a tax break.
People aren't going to give up fitting their kids in the car just to save a couple $1,000s.
The car has to work for their life, period.
Okay, so demand is there, but it's very specific. They want hybrids, they want EVs that fit. So let's flip to the other side of the coin. Supply. Is the market actually delivering what people want?
Well, this is where the chaos really ramps up. According to data from Auto News Talk on the used market, what we're seeing is basically an inventory flood.
A flood. Is that a trickle or dam breaking?
The dam is definitely cracking.
Yeah.
The numbers show a huge surge just in January. We're talking a 24.3% jump in pre-registrations.
Okay, let's pause on that. For anyone listening who isn't in the business, pre-registrations is basically the industry's way of juking the stats, right?
In a nutshell, yes. It's when a car maker or a dealer registers a car to themselves just to hit a sales target. So on paper it's sold, but in reality it's a brand new car sitting on their lot.
Which then gets sold as a nearly new used car.
Exactly. And on top of that 24% jump, there was a nearly 25% increase in EV advert volumes. It's just a lot of supply hitting the market at once.
And Econ 101 says when supply shoots up like that, prices.
They fall fast. The source points to a $489 drop in average EV prices in just 1 month.
Wow, if you're a dealer holding that inventory, you are losing money every single day.
You are. And the why behind it is really telling. It's regulatory pressure. The report blames the ZEV, the zero-emission vehicle, mandate.
Compliance targets.
Car makers have to sell a certain percentage of EVs or face massive fines. So if people aren't buying them fast enough, they just pre-register them to hit the number. The market is being flooded to satisfy a spreadsheet, not a customer.
So that's the market forcing prices down through an inventory glut. But we also have a report about a government doing it in a totally different way. I had to read this Canada report twice.
The Canada situation is wild. It's a complete geopolitical outlier.
Yeah, normally North America moves as one big trading bloc, but Canada is suddenly going its own way on Chinese EVs.
A complete 180-degree turn. They're allowing a quota of 49,000 Chinese-made EVs to come into the country at just a 6.1% tariff.
And just for context, the old tariff was what?
It was a 106% duty. Basically a giant wall to keep them out. They've just replaced that wall with a tiny speed bump.
But why? Why risk angering the U.S. and Mexico?
One word: affordability. The source is explicit that the goal is to get at least half of these imports priced below 35,000 Canadian dollars. They looked at the market and realized they will never hit mass adoption with $60,000 SUVs.
They need cheap cars, and China has them.
It's a huge gamble.
Yeah.
They're hoping this jumpstarts their market and maybe, just maybe, convinces some of those companies to build factories in Canada later on.
But the tension with the U.S. must be immense. The U.S. is building tariff walls higher, and Canada is just opening a side door.
It creates a mess for North American supply chains. But look at the pattern. In the UK, prices are forced down by a supply glut. In Canada, they're forced down by legislation. The result is the same.
Which is great for a consumer, maybe, but if I'm running a dealership, I'm starting to sweat. My inventory value is dropping, my margins are razor thin. How do I survive?
And that takes us right to our third pillar, the operational shield. When sales get tough, the whole industry retreats to one place.
Fixed stops, the service lane.
The unsexy but profitable part of the business. But according to a Traver Connect report in Digital Dealer, even that safety net is starting to look a little frayed.
How so?
They flag a specific number dealers need to be watching. A critical warning sign.
What's the number?
70%. The report warns that if your due for service customer retention rate drops below 70%, you are in the danger zone.
70%. That feels really high. I feel like most stores running at 50% think they're doing okay.
In a boom market, maybe. When you're making thousands on every car you sell. But in this market, where your sales margin is vanishing, 50% is a catastrophe. You have to keep that service customer. It's your only reliable cash flow.
So why are they leaving? Is it just that the dealer's more expensive?
No, and that's the most interesting part. The report argues they're not leaving over price. They're leaving because of friction.
Friction.
Yeah, it's just too much of a hassle. The online booking tool doesn't work right. You get put on hold when you call. No one calls you back with an update. It's just not a modern, seamless experience.
So what's the solution they propose?
They call it hybrid scheduling.
Is that word again? Hybrid. It's the theme of the day.
It really is. But here means AI plus human. The idea is that 100% online tools fail because they can't handle complex problems, and 100% human call centers get overwhelmed.
So you use AI for the simple stuff.
Exactly. Let the AI handle the routine oil change booking, send the reminders, manage the schedule. But, and this is the key, you have a human ready to jump in the second a place. A customer has a tricky question or a weird problem.
So you use tech to make the experience feel more human, not less.
Precisely. It's all about removing that friction. That and convenience things like pickup and delivery. In this market, keeping that service bay full is your shield. You can't afford to lose a single customer.
Okay, so dealers are shoring up service. Governments are messing with tariffs. What about the big money, the investors? Are they buying into this chaotic future?
Well, this is where the story gets a little cold. There's a report on a major deal between Apex Partners and Pinewood.ai that just fell apart.
Remember this. Apex is a huge private equity firm. Pinewood is a big deal in dealer software. This felt like a major vote of confidence.
It looked like it was a done deal. And then, pretty suddenly, Apex just walked away.
Did they say why?
They were surprisingly blunt about it. The official reason was challenging market conditions.
Which is investor speak for, we don't think we can make enough money fast enough.
That's it, exactly.
Yeah.
It's a huge signal that the easy money era for auto tech is over. Investors are getting cold feet, they see the price drops and the margin compression we've been talking about, and they're hitting pause.
But Pinewood isn't just giving up, are they?
No, far from it. They're pushing ahead on their own. The source mentions they're acquiring another company to boost their AI, and they've signed a massive new contract with Lithia, one of the biggest dealer groups out there.
So they're betting on themselves to prove the investors wrong.
They have to. They've set this really aggressive target, something like $60 million in revenue from these new ventures. But there's this little regulatory twist to the story that I find fascinating.
Oh, do tell.
It's called Rule 2.8. Basically, since Apex walked away, they're not allowed to make another offer for 6 months, but this rule leaves the door just slightly ajar.
So it's not a no forever, it's a no for now.
It's a wait and see. And that uncertainty sends a chill through the whole sector. It tells every tech company that the big checks aren't coming until this market stabilizes.
It really feels like the whole industry is holding its breath.
That's a great way to put it.
Okay, let's try to pull all this together. We've gone from consumer polls to Canadian ports to investor boardrooms. What are the big themes you see emerging?
The first, and I think the most important, is this hybrid reality. And I mean that in every possible sense.
It's not just about the engine.
Not at all. You have consumers screaming for hybrid cars. That 30.5% figure is the market talking. And then you have dealerships needing hybrid operations, that mix of AI and human touch to survive.
So the big lesson is that flipping a switch to all electric or all digital just didn't work.
It didn't. The sweet spot, the winning formula right now is the mix. It's about turning a dial, not flipping a switch.
And the second big theme?
It has to be the affordability squeeze. You've got this flood of used EVs in one market pushing prices down, and a government in another basically importing cheap cars to do the same thing.
Which creates a paradox, right? Lower prices are good for buyers.
But they make the economics incredibly difficult for the businesses and the investors behind them. It's a great time to be a car buyer, but a terrible time to be a car seller.
And that creates some real tensions. What's the biggest conflict you see in the data?
Geopolitically, it's that North American trade situation. Canada is opening a door to Chinese EVs while the U.S. is building a wall. You can't have a coherent continental strategy like that. It's a massive friction point.
And what about for the consumer?
It's that confidence gap we talked about.
Yeah.
The data shows people want to switch. That 55% is real intent. But then they see the market volatility and the price drops and they get scared.
They're worried the car they buy will be worth thousands less next month.
And that fear is a powerful brake on mass adoption.
So let's bring this home for everyone listening. What's the practical so what from all of this?
The big takeaway is that the wait-and-see era is officially over. The inventory is here. The prices are dropping. The dealerships are retooling their most profitable departments to keep customers happy.
So if you've been sitting on the sidelines, the game is on.
The game is on. And for anyone in the industry, the message is clear. Hype won't save you anymore. You need operational excellence. You need that smart hybrid approach to everything you do.
It's time to optimize.
That's the word.
And that really does seem to be the theme here, optimization. A government is optimizing its tariffs, the dealer is optimizing their service schedule, an investor is optimizing their timing. Everyone is just tweaking the dials, trying to find some stability.
And that's often when the most interesting innovations happen. When things get hard, people get smart.
I like that. Let's end on a little bit of optimism.
We can try.
That does it for this edition of Auto News Talk. A huge thank you for connecting all those dots for us.
My pleasure.
And for you listening, keep your eye on that hybrid trend, not just under the hood, but in how businesses are mixing technology and people to solve these new problems. That's where the real action is. Thanks for listening to Auto News Talk.